The best investment you've probably never heard of. Many financial advisors aren't very savvy when it comes to alternative investments. They're often misinformed on the subject and only offer what their firms allow them to sell. However, large institutional investors and hedge and pension fund managers are experts in this area and have recently put billions into a unique investment alternative called life settlements. What is a life settlement? It's when an individual, often an older adult, sells their life insurance policy to a third-party investor for more than the policy's cash surrender value, what they'd get from the insurance company, but less than the death benefit amount. The insured person, in exchange for an infusion of cash they require for various end-of-life needs, transfers ownership of the policy to the investor, who becomes responsible for everything related to the policy, including the rights to the death benefit payout. So why invest in life settlements? The primary advantage of a life settlement investment is the potential for a competitive rate of return without any of the risks of other investments like stocks or real estate. In fact, a study published in 2013 by the London Business School found that the average expected return among institutional life settlement investors was greater than 12% annually. Life settlements also offer a compelling risk-reward profile as a socially responsible investment, which can be a win-win scenario for both parties. So if you are a financially qualified California investor, find out more about investing in life settlements today.
Okay.
Okay, good morning, everybody. So I'd like to welcome you all to our live settlement presentation by Equilife. And live settlement has been very popular lately because Warren Buffett's investment in life settlement. So he invested almost $1 billion in life settlement, and also another famous investor, Mr. Bill Gates, is one of the top rich people in the country right now. And so let me introduce our speaker. Yeah, he has been in the life settlement industry since 2016, and he has worked with several of the largest issuers in the life settlement industry, assisting hundreds of investors with tens of millions of dollars in life settlement transactions. Since its inception, he has grown Equilife into the premier life settlements company in California. And he's also a native of San Francisco Bay Area and one of the most trusted CEOs in the country today. Ladies and gentlemen, please welcome Mr. Barry Neal.
Thanks.
Take it away, Barry.
Yes, thanks. And let me preface today's discussion by saying this is for Equilife Life Settlements. Okay, so this is a California-only company. So investors are required to be California residents. They're required to be financially eligible. We can talk about what those financial eligibility requirements are a little bit later after we get you excited about the product. But allow me to go through a short and sweet presentation today and give you an introduction to what life settlements are, what they can do for you, why now is such an exciting time to be investing in life settlements. We did start Equilife years ago, and life settlements were, I think, always a good product, but you don't invest in a vacuum, right? You invest based on the economic conditions of the day, and you're weighing this investment against other options. Of course, before we get started, a disclosure that don't take what I'm saying here as the offering itself, okay? You have to read the offering documents, okay? Now that that's out of the way, many people have money in the stock market, probably the biggest place to have investments, okay? Maybe cash savings. Let me also say right at the outset that we can invest through IRA as well. So whether you have IRA in the stock market now and you want to move that over to life settlements, or maybe move just part of it over to life settlements according to your goals and risk tolerances, etc. We can talk about how to invest later on, but first let's talk about what your alternatives are. So if you've been following the stock market, you know, today is September 15th, 2022. The S&P 500 has been down all year. It's down 18% year to date. We have flirted with a 20% down market this year. That's by some definitions a bear market. And so really the days of set it and forget it in the stock market may be over. This might be the beginning of something big, like we saw in 2008 or even the Great Depression. We might recover and go down later, but it's becoming a more popular opinion that the stock market will suffer greatly in the years ahead. That is my personal opinion. Of course, I'm not going to put an exact date on when that will happen, but what's beautiful about life settlements is that they're completely unaffected by stock market downturns and risk, okay? Even several insurance products today, other types of products, investments that wouldn't seem to be immediately affected by the stock market are tied to the stock market through indexing, et cetera. But life settlements are something that's completely unrelated to stock market downturns. Similarly with real estate market crashes, again, even this year, we're seeing the real estate market suffering, starting to go down in recent months. Valuations still near all-time highs. Will we see another 2008 style correction soon? We might. And whether we do or not, life settlements, of course, decent option, but you'll really be glad you had them when we're in these volatile economic conditions that could see stocks, real estate markets suffer. Of course, it's difficult to time these things. You do have to get set up beforehand, before the S hits the fan, right? Because it's impossible to time the market. I mean, even the best traders can't really time the market very well. You can't just be in the risky things until it's time for a crash and then quickly scuttle over to the more safe haven assets, right? You need to be set up beforehand because these moves can happen very quickly, okay? Just like we saw in 2020 stock market or the S&P 500 index going down 30% in 6 weeks. I mean, these turns can definitely happen very quickly, okay? So what's the solution? We've already alluded to it, and Ferdy mentioned in his introduction that this is a tried and true asset class, okay? Warren Buffett, Bank of America, Chase Bank, practically any big bank you're familiar with has some life settlements on their books, okay? The reason for that is their non-correlated returns. You'll find that you're being paid out steadily regardless of what happens in other asset classes. So a well-diversified portfolio of stocks, bonds, real estate, might not be so well diversified when you consider that both in 2008 and at times during this year already, all those asset classes can go down at once. But regardless of what's going on in those, life settlements are still paying out steadily. So I consider life settlements to be true diversification, or at least add true diversification to your portfolio, no matter what else you're invested into. And let me say also that life settlements are not something you'd want to put all your money into, okay? If you have all your money in anything, you're not really diversified. But typically we're making recommendation for 10% of net worth for life settlements. Let's say your net worth is $500,000. You might invest $25,000 or $50,000 into life settlements, okay? This is a long-term study, 11-year study by the London Business School that found institutional investors like those banks we were talking about, Warren Buffett type investing, earning 12.9% APR over that period, which is just a fantastic rate of return. We'll talk a little bit later about what the exact return on our current offering is. We do come out with a new offering maybe every 4 months, give or take. Okay, as we sell one out, we start another one up. Each offering is completely independent from each other. And of course, your returns in this investment have nothing to do with what other investors in the investment do. Okay, we're not raising money to get a better product. We already have the product. You're buying a piece of it. It's independent of other investors. You don't have to worry about us not raising enough capital, okay? Let's start just from the very beginning. What is a life settlement? Everyone's familiar, I think, with life insurance, right? I pay now, I collect a death benefit later, or rather my heirs do, right? So in this case, Equilife owns life settlements. We own life insurance policies on insureds. Typically, we have 5 insureds in a portfolio. So we have 5 life insurance policies. We've paid now, we are collecting the death benefit later, but instead we are actually selling you as the investor death benefit, okay? So you can buy death benefit, not on yourself, but each time one of the insureds passes away, you're collecting your share of the death benefit, okay? We'll just look in a few slides here what our current policies look like. We're not just going to tease you. I'll show exactly what our offering today is. But realize that your payouts are coming from highly rated insurance carriers. Okay, this is a big deal. Insurance carriers, many laymen don't understand. Insurance carriers are extremely solvent, much more so than banks or hedge funds or practically anything else you can think of. Maybe the United States government is considered like the most solvent thing of all time. We have insurance carriers never having forfeited or defaulted on a death benefit claim for over 100 years, okay? Over 100 years. Even during the Great Depression, death benefit claims were paid. During the 2008 financial crisis, all death benefit claims were paid. So that's what I mean by solvent. That's real solvency, okay? It's not affected by credit ratings and deposits and default swaps like you can have at investment banks, etc. Someone smart out there might say, hey, AIG. I know 2008 AIG insurance failed. What happened there? Even AIG during the 2008 crash, that was their investment division, not their insurance division that failed. So we are actually being paid here by insurance carriers. So AIG's insurance division did not fail, okay. Like I mentioned, we have a portfolio of life settlements at any given time. So, the benefits to investing in a whole portfolio of life settlements, not just the diversification of one life settlement, but multiple life settlements. I think it's obvious that you're even further diversified with more policies, right? Before we get just into what our current offering is, I want to send home the point that this is perfectly legal. Absolutely, no question. For over 100 years, the United States Supreme Court has affirmed that life settlements are legal in the United States, okay? Furthermore, in the year 2000, California-specific legislation regulates life settlements, specifically fractional life settlements or pooled life settlements, just like we're transacting with, okay? So you can buy and sell pieces of life settlements in California. That's specifically regulated by a piece of legislation that's over 20 years old, okay? These are some early payouts. These are real checks paid to investors, okay? You can see a $750,000 check, $480,000 check, $100,000 check. Those are usually paid out to maybe 30 to 50 investors, but you can see these are real returns paid to investors. So that $480,000 check represented a 47% gain return to investors, was paid in 13 months, okay? Receiving a 47% return in 13 months is great, okay, great. By anyone's standards, that's just great, okay? That's $750,000 check was represented a 59% return to investors paid in 9 months, okay? Again, that's a 79% APR, which is just amazing, okay? So this is to say the business model works. These are real payouts that our company has paid to investors. And not only does it work, but you can receive just great rates of return, okay? These are not the average rates of return that we're advertising or suggesting you expect, okay? Let's look just at what kind of the regular scenario is, kind of what the current offering is, how it all works, okay? We're finally to our current offering. This is a $100,000 investment assumption. Hey, Barry, I like what I'm hearing. This sounds great. I like that there's no stock market risk. I want to put 10% of my net worth into something that's going to pay me out regardless of what's happening in the stock or real estate markets, etc. Right? I like owning death benefit. That sounds great. What do I actually get for my money? This is if you were to invest $100,000, just let's keep it simple, 100,000 is a round figure. Our minimum investment is less than that. Okay, this is not the minimum investment. We'll talk about those details, but first let's go through this example with these round numbers. $100,000 investment buys $175,000 death benefit. Okay, so you know your death benefit ownership to the penny from day one. This is great. You can see 5 policies of your 100,000. Let's take policy E, 16,400 is invested. Your death benefit ownership is 25,000. So as a hypothetical, let's say policy E matures first. Let's say in 4 years, policy E matures. What's matures mean? That's our polite way of saying the insured dies. Okay, the insured dies, you're getting paid. Great. You invested 16,400 into that policy. Your death benefit ownership is 25,000. You're getting paid $25,000. Okay. By the time all of your death benefits have been paid, you'll have realized your ownership of $175,469 death benefit. Okay. You may recognize some of these insurance companies. These are all highly rated insurance companies. Okay. Let's go on to the next page. This shows details for each policy. You might be thinking, oh, Barry, you know, these rates of return are fantastic. $175,000 on my $100,000, that's a $75,000 gain, a 75% estimated return. That's just great. But when do I earn it, right? When do I earn it? The other piece of the puzzle. We have life expectancies on this page. We have details on each policy, okay? You can see the age and gender of each insured. You can see the life expectancy in months. That's what that middle column is. So 59 months life expectancy, you know, that's just shy of 5 years, okay? These numbers are as of August, so, you know, it's reasonable to take up to a month off of these numbers, okay? So 58 months life expectancy, it's reasonable. That's an 81-year-old male, 71-year-old male. This is pretty typical. We typically have insureds in their 70s and 80s. Policy E is the oldest here with that 86-year-old female, 89-year-old male. It has the shortest life expectancy of about 4 years, 2 or 3 months. Looks like just more than 4 years life expectancy. The longest life expectancy in this portfolio is 95 months. So that's about 8 years, okay? You are paid as each policy matures. So if that policy E matures next week after you invest, you're getting paid your return straight away, okay? If a policy goes longer than expected, it's going to take you longer to realize that return, okay? Let's please save any questions till the end. I know we're recording here, so we'll have a nice clean recording, and then we can have questions at the end. Everyone has their own way of thinking about things, and if we have questions at the end, it allows me to present all the way through first. But that said, this page and this last page, this investment assumption, is the whole offering in a nutshell, okay? If you understand these 2 pages, you understand the basics of the product, okay? There's 5 policies. You're getting paid as each policy matures. The life expectancies in this case are 4 to 8 years. That's the whole product in a nutshell, okay? We'll go over some details, how this works. What is that California specific legislation I talked about earlier? This is actually great for investors. California is the best state to invest into life settlements as an investor. Okay, that's been my opinion for some time, just based on my experience, but actually there was an article that came out recently to the same effect. So if you want that article, I can send that to you after the presentation, but interesting article, just ranked each and every state in the United States and found California was actually the best place to be transacting life settlements. The reason for that primarily is the third-party administrator requirement. Hey, Barry, I like the investment. Sending in my $50,000 check. Where do I send it? You don't send it to Equilife. You don't send it to Barry Neal's personal account, okay? You send it to the third-party administrator. The reason is a third-party administrator oversees the investment, makes sure there's no funny business going on. Barry, it sounds too good to be true. How do I even know there are policies there, right? First Western Trust oversees the investment, and they verify there really are policies there in the account, and they make sure policies are being serviced, they're in force, and if everything is good and they have reviewed each and every transaction appropriately, Equilife can be compensated by First Western Trust. But everything of importance is approved only by First Western Trust first, okay? When you invest, you write the check, $50,000, that's great. You now own, let's just keep it round figures, I'm rounding here, you might own 1% of the portfolio, okay? So when the portfolio collects a death benefit claim, $500,000 check, $2 million check, whatever, you receive your 1% of that, okay? And don't quote me on the percentages. If you have a $50,000 investment, you're not going to earn exactly 1%, okay? That's why we have to look at the investment assumption earlier to get the exact figure. But typically you're in the investment, there's 30, 50, maybe 70 other investors in the investment. Your performance is not tied to other investors, okay? Until other investors buy the policies from us, buy their policy interests from us, Equilife just owns the difference, okay? But we do already own the policies, okay? Let's look at some fast facts, some nitty gritty. Minimum cash investment, $10,000. I said earlier, we can do IRA. We do a lot of IRA. If you've got an old 401k that you don't know what to do with it, it's been sitting over in that account ever since you left that employer 3 years ago, right? Minimum investment, just $25,000. We help with all the paperwork, getting that moved over. You can put that in life settlements. That's a great way to go. Maximum investment. Hey, Barry, if this is so great, why is there a maximum investment? Why can't I just put all my money into it? Because it's illiquid. It's an illiquid product, and we don't want to have all your money locked up if you have an emergency, right? The roof falls off your house. We don't want to have all your money locked up in something that's illiquid. So you're getting paid as each policy matures, but you may have to wait. The shortest life expectancy on this portfolio is 4 years. You may have to wait 4 years for a payout. It's true, you could get an early payout next week after you invest, but you might have to wait 4 years. So for that reason, we like to limit how much of your net worth is locked up in the investment. But we are expecting a decent growth for your commitment. Maximum investment, if you're accredited, if you meet that higher financial eligibility standard, we still, as a company, limit that to 15%, but we can't budge on the 10% requirement. That's by California law, okay? Let me define those standards quickly. Minimum to invest, period. You have to have a net worth of $250,000 and an income of $100,000, okay? Or income doesn't matter, you have a net worth $500,000, okay? Minimum. Then you can do up to 10%. So if you have a net worth $750,000, you can invest up to $75,000, okay? If you're accredited, that's defined by income $200,000 or net worth $1 million, okay? Simple, and then you can invest up to 15%, okay? We handle everything by DocuSign. So, some people were worried about COVID or maybe distance is an issue, timing, etc. Now we can do the whole investment online, which is just great. That's one of the best things to come out of COVID for us. We transition from, printed documents to DocuSign, and it's been a great improvement. And then when you finally receive your closing package booklet at the end of the process, it's nice, clean digital copies. Isn't that great? You also, by the way, receive your closing package booklet, receive a certificate of ownership from First Western Trust. Yes, you really do own 1% of the portfolio. Worst case scenario, that's a legally enforceable document that's signed by First Western Trust. You could take that to court and say, hey, I'm demanding my 1% of those payouts, and you'll get it, okay? Let's just wrap up here, and then we'll take some questions. If you've got some good questions, I'm sure it'll come through well on the recording. But this is a non-correlated investment. So I'm not poo-pooing the stock market. I'm not poo-pooing annuities, whatever else you're doing. But this is something that's going to pay out regardless of what's happening there. It's a growth-oriented investment that we're expecting decent gains over kind of a longer time horizon for your patients on these death benefit claims, okay? By the way, I would like to address the issue. Some people say, oh, Barry, this is morbid. I'm waiting on people to die. This is gross, right? On the contrary, okay, on the contrary, that these insureds would be stuck with their policy that they don't want, and they have nothing to do with it except for you, okay? So because of you, they can be cashed out, get rid of the thing they don't want. You're happy, they're happy, everyone's happy, okay? So they get cashed out, which is what they want. They want cash, you want the policy, you get the bigger death benefit, everyone's happy. It's a win-win. So in no way is this morbid, okay? They're going to die anyway, okay? So we all are, right? We all are. True diversification, regardless of what else is in your investment account, this is going to provide diversified gains. That means it's non-correlated. That means regardless of what the stock market's doing, you're getting paid, okay? Payouts from highly solvent insurance companies, right? The policies are backed by those carriers. They've been in force for a long time, okay? And they will pay out. You can invest cash or IRA. We actually do probably 2/3 IRA, 1/3 cash. Great option for IRA. Why? Retirement accounts, usually a longer time horizon model, and so are life settlements. Okay, it's just a good match. So we covered about all the basics. That's your introduction. If anyone has any questions, happy to answer questions, but would like to be respectful of everyone's time and keep this short and sweet for you. This is my contact information on the page. Whoever invited you onto this Zoom or sent you this recording, you can be in touch with them. I'm available if they're not available, but happy to answer any questions.
Barry, I have a question.
Yeah, go ahead, June. Yeah.
You may have addressed this question in the past, but I just want to
Sure.
have a clarification on that.
Yeah.
So, say an investor want to come in with $500,000, it goes to First Western as the third party. Who
Yes.
does the allocation? In your example of 7 million values for those 5 policies, who
Yes.
allocates and to which account will the investor's fund be appropriated to or allocated to?
Yes, good question. So, with any investment, we can prepare an illustration. So the illustration will be something similar to what you see on the screen here. And these percentages do not vary. So if you invest, let's say $1 million, then you can just add an extra zero onto all of these figures, okay? The estimated return stays the same. The investment amount per policy would go up by a factor of 10. The death benefit ownership would go up by a factor of 10, but all the percentages stay the same. So, we can prepare this document for any investment amount, but, if it's $50,000, you just cut these numbers in half, right? It's the same percentage because, look, the policies are of varying sizes. So you can see the smallest policy in this portfolio is that policy A, $500,000 death benefit policy. Policy B is the largest, 2.5 million. So you're owning 5 times as much of policy B as you are policy A, right? The total death benefit ownership on this portfolio is 7 million. We're selling the 7 million for about $4 million. Okay.
But does the investor have the option to choose? Let's say currently, if he puts in the funds at $500,000 and there are 5 active policies in there, does he have the option to choose where First Western actually would allocate it, or would it be First Western's job to do that?
Right. No, you receive a pro rata share of the policy based on the policy size. So, these policies were carefully selected with several ideas in mind, but, some policies are more expensive to acquire, some are less expensive to acquire, some are longer life expectancy. and pay you out more, and some are shorter life expectancy, pay you out less. So, at the end of the day, we have a nice blend of policies that will hopefully, pay you out regularly, steadily over the years. And so, it's not a pick and choose. It's just that you get all 5 policies, you get your share of each policy based on the size of the policy. So.
But the amount of the investment, say, for example, is $500,000, how would they break down to the 5 policies? Would they appropriate like 50, 20, 30, or 100,000? How much amount would be distributed by policies?
Right. So, looks like stop the screen share here. Let me open that back up. So, for example, let's say policy A, right? Its base amount is 500,000. The entire portfolio is 7 million. So policy A represents about 7% of the portfolio. We could take policy E, that's $1 million face. The entire thing is $7 million. So that policy represents 14% of the portfolio and on down the line, right? If it's a $1.5 million policy, then 21% of your initial investment will be placed into that policy, right?
All righty. Thanks, Barry.
You're welcome.
Yeah.
I think that's it. You can stop recording.
Cool.
So